almost 7.5% increase. All of that in Divide, McKenzie, and McLean counties. Divide and McLean both up about 12,000 barrels a day. McKenzie up over 50,000 barrels a day. And it's a response of the operators to the oil price. Oil price in October went above $40 for the first time since June of 2015. So the first time in almost 18 months we saw sustained plus $40 a barrel for North Dakota sweet crude. And operators responded to that by opening up wells that they had on restricted production and hydraulic fracturing several big producers, the Tarpon Pad in particular in northeastern McKenzie County. So we saw gas production increase a very similar amount, 6.4%. Really not that big an increase in the well count. About evenly split, up 43 on the unconventional Bakken Three Forks wells, up 47 on the conventional wells. So only about a 90 well increase. And so it's not attributed really so much to new wells coming on as it is to people looking at that price and saying we can now produce our wells at full capacity and make them profitable. So as I said, we hadn't seen those prices since June of 2015. Rig count today is up, back-to-back 3 rig increases since October and from September to October. So we're at 40 rigs today. And industry has indicated their intent to be at 50 rigs by the middle of next year. So we're looking for probably an additional 10 rigs to come on over the next 8 months or so. That's a real positive treat. Not, as I said, not that many new completions, and wells waiting on completion down just 1. Inactive well count down just 9. So there's still a backlog of wells waiting to be fracked and wells waiting to be returned to production. And with the weather that's come in now over the last couple of weeks, we're not going to see a lot of those idle wells put on production. That's going to really discourage people from fracking and putting workover rigs in the field. Very similar results for Fort Berthold for production off of the Fort Berthold reservation. A big positive in the natural gas price, up 50% because of the cold weather and withdrawals from storage. And so we saw a big bump in natural gas prices. That's encouraging for our shallow gas producers. But the one trick that we have in the whole month is gas flaring and gas capture. Capture fell statewide to 85%, right at the goal that the Industrial Commission has set for gas capture. And really almost all of that can be attributed to problems on Alliance Pipeline, and Justin will be able to address that more and probably in greater detail than I can. But it was a situation in Saskatchewan that resulted in Alliance Pipeline problems, and that just rippled through the entire system and resulted in, for example, the fee lands on Fort Berthold captured only 59% of their gas and flared 41%. So those are the kind of force majeure situations that the Commission anticipated in its gas capture rules and has accommodated and has a plan for accommodating those things. We are in litigation now on 2 Bureau of Land Management rules. We got the new Bureau of Land Management waste prevention, or as we call it, venting and flaring rule. We filed a motion to intervene in the case, which was originally filed by Wyoming and Montana. That was granted. We filed a motion for preliminary injunction, and the 6th of January, be making a trip down to Casper, Wyoming for a court hearing on that motion for preliminary injunction. We're litigating 3 rules from the EPA, and that's an ongoing battle there. And then just today, the EPA has released its final report on the impacts of hydraulic fracturing activities on drinking water resources. This is a report that's been 6 years and $29 million in the making. And interestingly enough, the revised final report, following the Scientific Advisory Board looking at it, really has changed it's essentially the same report. Very little change, but the conclusions changed. And the earlier conclusions that there were no widespread systemic problems with hydraulic fracturing and drinking water resources wasn't acceptable to the administration and what we've seen coming out of EPA over the last 8 years. They flipped that to say, under certain circumstances, hydraulic fracturing can affect drinking water resources. And so we've looked at the 6 circumstances that they've identified in the report. We need to do further review of the report because they say it's not recommending any policy changes. It's not criticizing any policy, but we've looked at the 6 circumstances they've identified in the report, and with the exception of a couple that don't apply to North Dakota has implemented either policies or rules to address every one of those circumstances. Doesn't mean that we'll stop there, but it's nice to know that going all the way back to our rulemaking in 2012, we have addressed every one of those circumstances already in our rules and policies in North Dakota. So we're glad to have that study behind us and glad to be able to report that we've already addressed all of the circumstances that it highlights, and we're hoping that we can move on. Oil prices are up, activity is up, production is up, and with the exception of gas capture, everything was a plus in October. I'll stop there and take questions. Nothing on the web.
I have one, but it doesn't make any sense to me, so I'm asking them too.
Please clarify.
Yeah.
All right.
Just on the weather thing, you said the weather is going to hamper the idea of getting some of these wells back into production. If we have a tough winter, that could be what could happen.
Sure. All along for the past 3 months, we've been predicting production declines, and so this big production increase comes as a surprise. If we have a tough winter, we'll go back to that trend of production declines and could very easily end up at that 900,000 barrel a day number by the middle of next year. It becomes expensive, if not impossible, to mobilize a workover rig and put a well back on production after it's been sitting idle for several months. And you try to put a workover rig on it and pull the rods and tubing and get the thing back to pumping. That just doesn't happen at minus 30 temperatures. And likewise with hydraulic fracturing, the fracturing fluids need to be at 100 degrees Fahrenheit to pump them down the well. And the costs of doing that, of moving the water and keeping it warm like that, are pretty great in winter weather. So I wouldn't expect a repeat of October during these winter weather months. It just becomes expensive, if not impossible.
Meaning that it's not very likely we stay above 1 million barrels a day, because of course that's then the next question is.
Absolutely. It's highly unlikely that we'll stay above 1 million barrels a day.
Okay.
The trend of going back to 10,000 barrel a day or 20,000 barrel a day decreases month to month is more than likely where we're going to end up as we go through the winter.
Okay. You mentioned Northeast McKenzie County. How is that activity compared to Northwest Dunn, which we talked about experiencing better production in September?
Yeah, so I think you can still see some of the effects of activity shifting to Northwest Dunn in the fact that oil production went up 7.5% and gas production only went up 6.4%. So northwestern Dunn County has lower gas oil ratios, and so with the exception of one operator who saw an opportunity to bring a lot of highly productive wells on in northeast McKenzie County, the activity continues to shift into northwestern Dunn County. And Corral Creek unit is in northwestern Dunn County. The operator there is bringing rigs back and planning to get back to a 2 or 3 rig program next year. So we're going to continue to see, I think, activity move to some extent to northwestern Dunn.
And those three counties again that had the production increase were
Divide, 12,000 barrels a day, McLean, 12,000 barrels a day, and McKenzie, a little over 50,000 barrels a day. Doesn't account for 100% of it, but it's almost all of it.
Can you provide some color as to why you think Divide would provide an increase since it's outside of that core area?
Yeah, the increase in Divide County was in the southeastern corner of the county, which is almost in the core area. It's equivalent to the kind of productivity that you see in eastern Williams County. And so, again, activity on the basis of operators in the southeast corner of Divide County, not up along the Canadian border or up in the Grenora area where well productivity is a lot lower and water production is a lot higher.
Do you think the increased production could also be attributed to accelerated new developments in proppant and sand use?
Maybe to some extent. The northeastern McKenzie County production increase, those were all 50-stage super fracs, and so those wells that the operator is putting on there are all super frac wells and very high productivity wells with IPs of over 3,000 barrels a day. So, but when you look at, for example, Divide County, the major operator that saw production increases in Divide County is the one who was restricting production in July and August because of low prices, and liked that $40 price signal and saw that it was an opportunity to improve cash flow at an attractive price.
Can you talk?
Go ahead, Jeff.
Can you talk a little bit about you mentioned the industry had signaled that 50 was the number of rigs they were shooting for. Is that enough to keep the production from slipping, or what does 50 do at this stage?
The question was, is 50 drilling rigs enough to stop the production decline? I repeat that because the webinar folks can't hear your question. And the answer is not quite. We use a 1.5 wells per rig number, 1.5 wells per rig per month number, and that gets you at 75 wells a month, and we actually need closer to 90. So 60 rigs would really be the magic number to reverse the production decline and turn the trend the other way. At 50 rigs, it'll be a very slight production decline, maybe flat production at 900,000 barrels a day.
And did this October performance kind of really put a highlight on how important the price is to making this happen? If the price can make such a difference in one county like that? Yeah,
the question was, does the October performance really point to the importance of price? And absolutely. We had seen prices flirt with $40 a barrel, North Dakota Sweet, but like I said, been almost 18 months since they've been there, and that price justifies flowing wells at maximum efficient rate and actually keeping wells on, not idling wells, and in good weather returning wells for production. So that's a very important price signal. That would equate to roughly $45 a barrel WTI, and we always said that was an important price point for workover rigs and flowing wells at full capacity. $50 a barrel is really WTI is really the important price signal for a lot of frac crews moving in and reducing the 860 non-completed well count. That is going to equate to around $45 a barrel North Dakota Sweet, and we're not quite there yet, but we expect that in the first quarter of 2017.
Just have an odd question. You use Flint Hills Resources for the price.
Yes, sir.
Basically, how much Bakken crude goes to Flint Hills? Do you know offhand?
I'm going to let Justin answer that, okay. And I think that's mostly what goes down Enbridge's system. Okay. So the northern system that runs along Highway 2 all ends up dominantly at Flint Hills, and Flint Hills tends to be lower than what operators receive at the lease. WTI tends to be higher. And generally what they're receiving at the lease is the arithmetic average of those two. So this tends to be like 15% low, and WTI tends to be 15% high. We use it because all of our historic prices were published by Amoco Refinery over here in Mandan. When they stopped publishing a price, the one that matched that the closest was Flint Hills, North Dakota Sweet. So in order to be able to track the history all the way back to the 1950s consistently, we switched to Flint Hills.
I think Justin's going to touch a little bit about Alliance Pipeline, like Lynn indicated, but there are some questions about if you think impacts on gas capture will continue into November, and if you know of anybody that's self-restricting production, if they did that in November.
Great questions. So I'm not aware of any self-restriction in November. In fact, I'm anticipating, and I'll get you some further information on this, but I've been told that Hess actually has been able to bring their Hawkeye system online. And so maybe towards the end of November, we're going to see a big improvement in northeastern McKenzie County in terms of gas capture. Also in November, the Wild Basin plant and the Bear Creek plant both reached full capacity. So I don't think we're going to see gas capture resulting in any kind of production restrictions in the month of November. I'm not aware of any mechanical issues, and there were several positive steps taken in terms of increased capacity with those two plants and with that pipeline under the lake.
Okay. Are you confident then, even though we're still expecting to see production drop, do you think that's still likely if prices stay above $50?
I think it is. I think that, again, we talked about having to get to $50 WTI is going to bring fracking crews, but we're in the winter weather time now. So we've reached and probably are going to sustain about the price point, but we're now in the time of year when hydraulic fracturing in North Dakota becomes extremely expensive and extremely difficult. So until we see March and April weather, I don't think those prices are going to help us in terms of the fracking and the production that will come from that. And
you've touched on it a little bit, but maybe elaborate just a little bit more. Why is the cold weather such a concern for hydraulic fracturing?
Sure. So we still use, or industry still uses in North Dakota, 90+% fresh water for hydraulic fracturing. They have to store upwards of 20,000 barrels of that on the location to do the frac job, and that has to be maintained above 100 degrees Fahrenheit. So just moving it and keeping it warm when there's a minus 30 wind chill becomes an almost impossible task. They just burn too much propane and spend way too much time moving water and building ice inside those tanks.
Okay. Questions from the council?
So you're going to be going to Casper, Wyoming for this hearing in January?
Yes, sir.
Do you think we have a ghost of a chance? I'm sorry.
That's an awesome pun. And,
Casper,
we like the court in Casper because we believe in a friendly ghost. Yes.
The spirit moves you.
And we are, in fact, going to be appearing before the same federal judge who granted the preliminary injunction on the hydraulic fracturing rule. So that's another encouraging sign. It doesn't mean that we can let our guard down. We're going to make a strong case for the reasons that this rule is improper and the reasons that it impacts North Dakota, and we think we've got a winning case. When you have a situation where the BLM reaches out and says any private or state minerals that are committed to one of our federal communitization agreements, we're going to take over control of their permitting and their gas capture plans. That's an overreach on the part of the federal government, and we think Judge Skapdal will understand our reasoning there.
do you think North Dakota will be able to produce more now that there's a more, or will be, a more industry-friendly, and using air quotes, White House?
I certainly think so. I think that what we've seen over the last 6-8 years in things like the hydraulic fracturing drinking water resources study, there's going to be far less of that. And so, we're in a situation right now where we're litigating 5 different rules that came out under this administration. We don't anticipate anything like that out of the new administration. So the focus will be on capital investment, good regulation, increasing production, as opposed to dealing with federal rules.
If prices stay above $50 a barrel, is the worst over?
I believe so. Unless we see some surprise, some trick that drops prices back below $50 a barrel, the worst should be behind us. And it ought to be from here, maybe some production decline before it levels off and turns back up. But I think the worst is behind everyone for the industry and for layoffs and for reduced investment.
Okay.
Thank you much.
There we go. Well, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'll get right into the usual information and then provide some additional color on some of the topics that Lynn had been discussing earlier. Production update from around the region. Again, 0 rigs, 0 activity as far as new wells being drilled in both eastern Montana and South Dakota. So we're continuing to see those production slides in those neighboring states. On the overall transportation dynamics from the Williston Basin, we saw a slight increase percentage-wise on the crude by rail, slight decrease percentage-wise on the crude leaving by pipeline. As you just heard from Lynn, we saw production increases in North Dakota substantially. And then you'll also see in a few moments, we saw additional barrels coming into North Dakota from Canada to the tune of about 20,000 barrels per day. And so that additional production coming in, and additional production from North Dakota, majority of that was getting on the rail systems in the month of October. So when we look at some of the historical trends, this is a little bit of a shift from what we've seen in the last number of months, again, with more of those barrels in the month of October being estimated to be moving on rail rather than by pipeline. Overall, from historical trends, crude by rail still estimated to be down from what we've seen in past years, but in the last couple of months we have seen a trend upwards, particularly in October with the increase in production, not only in North Dakota, but those additional barrels coming in from Canada. Where those crude by rail barrels are going, we saw the lines separate a little bit again, favoring the East Coast, the PADD 1 region, but at a very close second, PADD 5 being the West Coast refineries up in the Pacific Northwest part of the U.S. Pricing, the latest, what the different PADDs, what the refineries were paying on average. Again, if you took a look at the previous slide and where those barrels were going, particularly on the crude by rail, take a look at the East Coast, PADD 1, slightly better pricing than the West Coast, PADD 5. And so really no surprise when we look at this pricing, look at what the trends were. It starts to explain itself quite clearly. Where we sit today, almost a $3 spread now between Brent and WTI. That has widened a little bit here in the last number of weeks. Almost $56 Brent pricing as of this morning, and then just over 53 in the Mid-Continent Cushing marketplace. As I mentioned earlier on slide 9, this is the crude imports, exports between North Dakota and the neighboring Saskatchewan, just across the border to the north. Again, you'll notice that red line, that very sharp uptick in imports into the region. Having just received this information, I don't have a whole lot of color yet as to what was taking place, if we were going to continue to see that, or if it was just a one-off kind of a marketing situation that we'll see go back down to some more of the more recent trends that we've seen. On the gas capture side, as Lynn alluded to, with Lynn's numbers, 15%. My numbers don't include confidential wells, so I'm showing here 14% gas flaring. We have seen the majority of that gas coming from wells that did have gas sales associated with them as well, and so that does correlate with what was taking place with the Alliance pipeline system, and then I'll mention here in a few moments some of the other connecting systems to the Alliance pipeline. And so those were wells that, again, traditionally were capturing their gas, traditionally were able to put it into the marketplace, but because of disruptions that took place in October, they were not able to get all that gas into the network. And you'll notice, again, historically, this is a trend upward from what we've been seeing over the last 6 months or so. And then as far as gas connections on slide 12, again, the industry keeping pace with the new completion activity in the region. So again, good news on that front, that the gas gathering industry is keeping pace with current drilling and completion activities. So on slide 13, this is really what I wanted to highlight. You'll notice here in blue, that is the Alliance pipeline system. On the map on slide 13, what you don't see is the Alliance pipeline continue up into Canada. So that pipeline originates in British Columbia, travels through many of the producing areas of Western Canada on its way down to the Chicago marketplace. And what was taking place in October, I did print off for the folks in the room a couple press releases from Alliance just with some details of that outage. And so it was a planned outage on the system. They were working on 2 new segments of pipe in the Regina area to accommodate some highway work. And so during that outage, which took place from October 12th to October 20th, the entire Alliance pipeline system was shut down. And that is a 36-inch line, 1.6 billion cubic feet of gas per day capacity system, which by and large carries mostly Canadian gas on its way to Chicago. But you'll notice on slide 13, there are 2 pipelines that connect to the Alliance system, the Tioga Lateral, and more importantly in this situation, the Prairie Rose pipeline system. And so the Prairie Rose is a 12-inch line which moves dense phase gas, meaning the natural gas liquids are still in it on its way down to processing in Chicago. And so that Montreal County area, the producers, the gathering systems that were all connected into Palermo, which is the origin point for the Prairie Rose pipeline, during that outage, those systems had to essentially flare their gas. They did not have a market outlet for that gas during that outage. And so there are some questions of whether or not if this is a long-term issue. No, the system was brought up online October 20th. Gas is flowing again. Prairie Rose pipeline typically flows just over 100 million cubic feet of gas per day, and that is back up and operating as normal. So we should not see this impacting the November figures and going forward. And just while we're talking about gas capture, just some other recent work that I've done on wellhead gas capture that's been a topic of discussion in North Dakota is the mobile units that can be deployed out to locations around western North Dakota to address gas capture. Here's just some updated statistics on where we sit in North Dakota. This is the number on slide 14 of gas capture units currently active historically, and then up through August. You'll see that back in late 2015 was the peak number of locations utilizing the gas capture technology at the wellhead. That has trended downward. On slide 15, on the overall gas being captured and processed through these wellhead units, that as well peaked in 2015 and has trended downward since more traditional gas gathering and processing has taken over in a lot of the regions around western North Dakota. And then from an NGL output, so many of these units, their primary goal is to strip natural gas liquids from the gas stream at the wellhead. And this is just an update on what type of volumes we were seeing coming off of these units and then getting put into the natural gas liquids marketplace in North Dakota. So just under just under 2,000 barrels at its peak, and now hovering just right around 1,000 barrels a day of natural gas liquids being captured by these units out in western North Dakota. And for comparison, lastly on slide 17, on the bottom portion of this slide, you'll notice that is the traditional gas gathering and processing industry. And at its peak, the field units were 2.7% of total gas capture within the state. And so again, primarily the gas gathering industry is continuing to be served, and we expect long-term that the more traditional pipeline systems, processing plants are going to continue to dominate that landscape going forward. So with that, I'd be glad to answer any questions.
Do you know approximately when the alliance was built or when it went online originally?
Off the top of my head, I can't remember that. It's relatively new comparatively to other systems, but I would have to get that information for you.
You mentioned that the alliance is back in service, and so you don't expect that problem. But I think it was number 12 or something. It showed that the capture rate has been dropping. I think it's one right before this. Yeah. So that am I right? Flaring has gone up over the last several months. I mean, what's the long-term factor there? You know?
Yep. And so on the near term, this large increase that we saw in October, that could be attributed to the pipeline outage. In recent months, again, taking a look at some of the higher producing areas and just getting the right size pipeline system, the right plant size in the right place at the right time has been continues to be challenging. That we've had some very productive wells continuing to produce, in particularly in northeast McKenzie County, which does prove challenging to those gathering and processing that gas and keeping up with the activity levels there.
Does it become a financial question for the companies then? I mean, whether it's worth it to make the investment to capture the gas as opposed to reducing production or something as a penalty? You know what I mean? Is that at play there?
Well, definitely. So as these wells come online, the more molecules they can capture and get put into the pipeline system and processed and put into the marketplace, the better. And so they're always trying to, whether you're the producer or whether you're the gas gathering company, the goal is aligned there, and that they want to capture those molecules and get them sent to market as quickly as possible.
Do you think the $2 spread between WTI and Brent is enough to increase crude by rail shipments?
You know, it's hovering, and so just this morning it was almost $3 spread. You're starting to get to that point. It was, in the past, we've seen it typically that $3 to $5 spread is where we've kind of seen those shifts back and forth between choosing pipe versus choosing rail. And so we'll see how that market continues to move here in the coming weeks and months. If we start to see that widen again, you could see more and more barrels choosing the rail network versus a pipeline network.
What do we know about the Black Hills pipeline with the spill? What do you know about in terms of how old that pipeline is? Did it have leak detection equipment on it? Have you done any looking at that?
So that would fall under
We have to talk about that because Justin's non-regulatory, so
okay.
We can answer that question when you're done.
Okay. We'll do that.
Okay. All right.
Okay. Thank you very much.
Would Lynn be answering that question?
We're going to bring Kevin Connors.
Yeah.